Good afternoon, ladies and gentlemen. My name's Tony Katsigarakis. I'm the Commercial Director in the Corporate Reporting Solutions Group at Wolters Kluwer, not CCH. We are now officially known as Wolters Kluwer, although we still call our product CCH Integrator and so on, but official as of this year. Take great pleasure in welcoming all of you, our chair and our panel. To everybody's favourite topic, I'm sure everybody goes away on their Christmas holidays looking forward to FBT and payroll. See lots of familiar faces and the group seems to grow and grow, so it must be a topic of high fascination. So I'm sure you'll find today's session quite informative and enjoyable. Before I hand over to our chair, who's Fiona Richard, who's the tax counsel at Coca-Cola Amatil, just a few housekeeping matters. If I could ask all of you to switch off your phones or put them on mute. If you could save all your questions to the end. And just highlight a couple of things in the packs that are in front of you. Towards the end of the session, we'll ask you to complete your evaluation form. These sessions are your sessions. They're actually managed and steered by your peers. So we value your feedback very, very highly. So please complete those before you leave. And the last piece, on the 4th of May, we're running a tax risk workshop in Sydney. If you haven't registered for that already, I'd encourage you to have a look at that. It seems to be the hot topic at the moment. We're running a whole bunch of sessions around the country and virtually all of them are totally booked out. So if that's an area that affects you, and I think it affects all of us, yeah, please have a look at that and join us in early May. So without further ado, I'll hand over to Fiona. Thank you.
Thanks, Tony. Well, welcome to the annual FBT and Payroll Tax Compliance Update. I'd like to welcome our speakers today, Glenn Smith from the Australian Taxation Office and Wayne McMillan from the Office of State Revenue, and our panel of commentators from right to left. Now that'll probably confuse you. So Paul Ellis is on the very far end, Donna Rubo, Adam Nicholas and Marty Heinrich. So welcome everybody, and without further delay I'll hand over to Glenn. Thank you.
Thank you, Fiona, and thank you everyone for coming along to take the time to attend today's session. I'll be giving an update on FBT with some of the areas that the ATO has been looking at this year, and also some areas where there's been some changes. Firstly, return lodgement dates. They're the same as for last year. They are on the screen and there's a copy of this slide in the packs that you do have. The standard due date is the 21st of May. If you're lodging your return using a tax agent and the tax agent lodges electronically, they have until the 25th of June to lodge that return. If you can't lodge by the due date, it is important that you request a deferral from the ATO before the due date to lodge it by a later date. To do that, you can simply lodge your request using the business portal on the ATO website. The FBT rate for the year that's nearly finished has increased from 46.5% to 47%. In line with that, the two gross up factors or gross up rates have also increased. They're on the screen. For the following FBT year, the FBT rate, as a result of changes to individual tax rates, will increase to 49%. In your pack there is a slide there in the presentation which gives fuller details of these two rate changes, including some of the thresholds, etc., that relate to certain not-for-profit entities. There haven't been any other significant law changes for the current year, although on this slide you can see that there are 3 recent law changes that all had transitional rules applied to them. Firstly, the car fringe benefit statutory formula. For cars acquired after the May 2011 budget announcement, it's moved to a flat rate of 20% if you're using the statutory formula. So that means for this year and also later years, if you're using the statutory formula for those vehicles, you don't need to keep odometer records at the start and the end of the year. However, if you are using the operating cost method or contemplating using that method, you may still need to keep those, as you would if you've got any cars that relate to prior to that budget announcement in 2011. Living away from home allowance, there were some changes made to the law for those allowance payments and also similar benefits from the 1st of October 2012. There were some transitional rules. If you had employees that were eligible for those transitional rules, they expired on the 30th of June 2014, or if not before that date. So the new rules apply to everyone without transitional provisions from the 1st of July 2014. In-house benefits, which is benefits, items that you give or sell to your employees at a discount, which are items that you normally sell or provide to members of the public as part of your business. There were some changes made. The salary packaging of those items wouldn't attract the concessions that are applicable to other in-house benefits. There were some transitional rules there that ceased on the 31st of March 2014. So when you're looking at your 2015 return, those transitional rules cannot apply. With the living away from home allowance changes, the ATO will be doing some compliance work to see how employers are complying with those changes. So if you are in that situation where employees receive living away from home allowance or similar benefits, it is important to check that the employee meets eligibility conditions for any reductions. So some of the things you need to consider there are whether they're maintaining a home in Australia that they're required to live away from. The concessions are only limited to the first 12 months for each location for a particular employee. There's also some conditions relating to substantiation and also some new declarations. So you need to make sure that you are complying with all those changes. Living away from home allowance versus travel allowance. We do get a lot of questions asking whether someone is living away from home or considered to be travelling. Because there are different tax treatments for those two things, it is important you get it right, and we will cover a little bit later on some issues around that to clarify it. Some other areas to watch in relation to car benefits, which is the most commonly provided fringe benefit, is firstly if you're using the operating cost method to make sure that your logbooks are current. They're only valid for 5 years. We do find when we do audits and reviews that employers think they have got a logbook that's 4 years old, but when they go looking they find out it's 7 or 8 years old. So you need to have a system in place to make sure your logbooks are current. Also with the logbook or operating cost method, you need to ensure that you are considering all factors when you calculate the business use or private use percentage. Days not available for private use relates to the statutory formula method. We do find that a lot of employers incorrectly calculate the number of days a car is available for private use. They overlook some situations where an employee might be on holidays but have the car at home, and also they may miscount days that the employee has got it. If the employee takes the car home on a weekend, the car is considered to be available for private use on the Friday, the Saturday, the Sunday and the Monday. Quite often employers only consider it to be available for 2 of those days. Private use of what is known as exempt motor vehicles, which relates to utilities, vans, etc., that there is a concession in the FBT Act to say that private use is limited to home to work travel and minor, infrequent, irregular other travel, that those benefits will be exempt from FBT. We do have a lot of employers that aren't aware of those limitations and they don't convey that to their employees. So the employee just uses that vehicle unrestricted for private use, that there is an FBT liability there. So it is important if you do have those vehicles to have some procedures in place and also advice to employees about the limitations. When we were planning these sessions, we got a request to cover some superannuation guarantee, which is another charge that's administered by the ATO. Some of the areas to look out for there for superannuation guarantee is the employee versus contractor issue. You need to ensure that if someone is being treated as a contractor, that treatment is correct. We do have a decision tool on the ATO website to help you with that, because if you just assume that someone's a contractor and really they're an employee, you can get a nasty shock and a large bill for superannuation guarantee charge sometime down the track. Also, employers have difficulty with what they have to include when they're calculating the superannuation amount, because if you pay on time, it's only calculated according to ordinary time earnings, not just total salary and wages. So there is a ruling there which you've got the reference SGR 2009 number 2, which clarifies which particular items of pay or which particular payments are included in ordinary time earnings and also what's included in salary and wages. Another important issue is when you're making superannuation guarantee payments is to pay the fund by the due date, because we do get lots of complaints from employees about funds being paid late, and we're obliged to act on that. So in some circumstances you may get additional charges if you do pay amounts late. Going back to FBT, some of the ATO compliance focus for this year is that we'll be focusing more on car fringe benefits, and particularly for smaller employers who tend to overlook the provision of car fringe benefits. We do get details from the state and territory registration bodies each year, and we match that against FBT return and income tax return data to see whether we think employers are properly accounting for the private use of those vehicles. Not-for-profit concessions. If you are working for a not-for-profit entity, it is important to verify the not-for-profit status of that entity to ensure that you are correctly eligible for the concessions that you're claiming, whether that be in FBT terms the rebate concession or the FBT exemption that applies to certain not-for-profit entities. It is important you to verify that, because we have had a number of organisations over the past year that thought they were eligible for a particular concession, but when we checked they weren't actually eligible for that concession, or they weren't properly registered with the ACNC to attain that concession. The new living away from home allowance laws, we've covered that on a previous slide, so I won't expand on that. And benefits provided to directors of private companies. This is something where we see a lot of private expenses paid by the company without having FBT paid on them. And when we do reviews or audits on these cases, we do get a lot of adjustments there. So if anyone is in that particular risk area, it is important to check any expenses paid for the directors. ATO consultation. Up until about 18 months ago, there was a forum known as the FBT Subcommittee of the National Tax Liaison Group, which discussed issues of, that were causing problems in the community about how to treat for FBT purposes. That subcommittee used to meet 4 times a year and nut out these issues and also make public the minutes from those meetings. Along with a lot of other ATO forums, that subcommittee was disbanded about 18 months ago. What it's been replaced by is what's known as a consultation hub. So if you do have an issue that you're not sure how it should be treated and you think it might have application to the wider community, you can go to the ATO website and submit that issue for consideration. If the ATO considers it to be one where consultation is needed, we will get together some experts to thoroughly look at that issue, and if there's not an ATO view on it already, we will publish the ATO view on that issue. There is one current FBT issue there at the moment, which is to do with the 21-day rule for employees travelling, which is another way of talking about the issue of whether an employee is travelling or living away from home. That committee met for the first time last week, and Paul, who's on the panel today, is on that committee, so he may be able to give us some information on what happened or what was discussed at that meeting last week. Red tape reduction. As you're probably aware, that the current government is driving to reduce the amount of red tape for business, particularly meeting tax and other obligations relating to government. Firstly, the dot point we've got there is tax white paper. There is going to be a white paper released about the tax system, and it may or may not have some recommendations about fringe benefits tax. So some of those are probably likely to target the reduction of red tape. Also, the ATO has established a number of safe harbour committees, and what that means is that we'll have committees set up, and FBT is one of those areas, which will be looking at ways for employers to have more certainty when perhaps they don't have all the information to meet the letter of the current law. And an example of one of the things that we'll be looking at with that committee, which meets for the first time next week, is the possibility of, if you've got a tool or trade vehicle, say a car that might be used by your sales fleet, of being able to imply a business percentage usage without the need to keep a logbook. Some other suggestions we have relate to the requirement to keep declarations for fringe benefits tax in certain circumstances, and another one is to do with the contemplation that you have to go to decide whether a benefit can be treated as minor and therefore exempt from FBT. So we'll be looking at perhaps providing some better guidance around that as well. That's all I had for FBT at the moment. So I'll hand over to Wayne to give the payroll tax update.
Good afternoon, ladies and gentlemen, and I'd like to thank you for attending, and also thank Fiona for welcoming me. This is it's been some years since I've been here, and I remember doing some payroll tax seminars to a packed audience, and it looks like we've got a packed audience today. I'm going to briefly take you through 9 key areas, as you can see there on the agenda, and you can follow from the booklet that you've got there with the slides. One of the important things is to remember that payroll tax has always been calculated on gross wages, not on net wages. These areas that we're looking at are all areas that our auditors have discovered sometimes during when they're delivering an audit, and it's important to continue to keep that in mind. The payroll tax will always be calculated on total Australian gross wages. Another important area is to do with the entitlement of the threshold. Obviously, where there are people working across borders like Queensland and the ACT with New South Wales, their thresholds are higher than our threshold. So as a consequence, there may not be a liability for the year in their jurisdiction, but there's quite possibly going to be a liability in New South Wales because our threshold is lower. So we have come across a few of these particular cases where clients have not been aware of that. Motor vehicle allowances. Very important to have substantiation. Now, Glenn just talked about keeping logbooks. If your employee doesn't keep a logbook, if there's some form of an estimate that could be kept of the business kilometres used for business, and that estimate could be extrapolated, that would suffice then for the next 5 years. But would have to be done over a typical 3 months period, multiplied by 4 for a year, and then you've got that then for the next 4 years. So it's most important that there is some substantiation for any exemption for the motor vehicle allowances. Now, if it is a car expense fringe benefit, again we would ask, if you're asking for an exemption, that you do keep records of the business kilometres. Employee shares and options. What we're finding here with these is that sometimes in the calculation, particularly with unlisted options, that some of our clients are not following the ATO methodology correctly. They're leaving certain aspects of it out in the calculation. So an employer can choose, they can elect to pay at the granting date, at the end, at the vesting date. They've got the choice to decide either, if they don't to pay at the granting date, then we automatically assume they're going to pay at the vesting date. If there is no liability at the granting date, then there will be no liability for payroll tax if it's nil. Obviously, the employee would make if they make a contribution or a discount, that would come off the amount which would be taxable. With fringe benefits, there is sometimes some confusion about using the gross up rate. We ask that most of our clients are using the estimation method, that they use the lower of the 2 gross up rates. Now for this year, because there was an increase from the 1st of July 2014, if you're using the estimation method, we're asking that you continue to use the 1.8692, which is the old gross up rate. However, if you've got actual fringe benefits that you're declaring to us, then you would be using the new gross up rate, which took effect from the 1st of July 2014, which is the 1.8868. So very important just to remember that we ask that you use the lower of the two. We're finding sometimes that people are declaring too much fringe benefits to us, or they're not using the gross up rate at all, and therefore we're not getting the correct amount. Also, sometimes they're using the reportable value which is found on their employee's statement of earnings. If you have a salary sacrifice arrangement for some form of a fringe benefit, a car fringe benefit in particular, the amount that's salary sacrificed is not to be declared separately to the fringe benefit. You'll be declaring it twice. If we see something as a fringe benefit, we follow the ATO's rules, it'll be picked up as a fringe benefit. If it has a nil or exempt value, then it will not be liable for payroll tax purposes. Third-party payments, where instead of the person receiving the payment or the party who should be making the payment, another party makes the payment. We've had a problem in particular with directors' fees. Instead of being paid to the individual, they're paid to their personal company. And there has been some discussion about them being consultancy payments. In most cases, we would see them as directors' fees, unless there is documentation to indicate that they have actually undertaken two services there, one as a consultant and one as a director. In most cases, they're just merely, as we see them, as directors' fees being paid to a private company. So we are coming across a few cases like that. So it's most important with third-party payments to remember that the organisation or the business that the person is providing their services to is the liable party. We seem to have a bit of a problem here with the clicker. Thank you. Okay. I'll go past there. Okay. Okay, so we'll move on. Okay, with apprentices and trainees, it's most important that that they be a genuine apprentice and trainee under the Apprenticeship and Traineeship Act. The department that actually decides whether a person is an apprentice or trainee and who administers that act is the Department of Education and Communities. What we're finding is that sometimes, also clients or taxpayers are forgetting to include all of the payments, and that includes superannuation. So when it comes to getting a rebate, they're not getting the full value of the rebate. You need to declare your apprentices and trainees' wages, including any allowances or superannuation, either on a monthly or an annual basis. And if you don't include everything, then you won't get the full value of the rebate, which is an offset. Again, with apprentices and trainees, sometimes inadvertently taxpayers are forgetting to tell us when the traineeship has finished or the apprenticeship has finished, and therefore there's a problem there in that they've been claiming the rebate for some time and they haven't notified us. Some clients still think that there is an exemption. Well, there isn't an exemption for normal general employees, only for non-profit group apprenticeship and traineeship schemes. Most general employers are getting a rebate. They're declaring the wages and a rebate is forthcoming. There's been some changes to our contracting provisions from the 1st of July 2014. We have changed one of our specific minor exemptions or exclusions, the one to do with owner drivers. We've inserted the word solely in there after we lost a case with the Smith's confectionery case, snack foods. And And as a consequence, we have loosened that one up considerably, I guess. We've also made a change to our anti-avoidance provisions under the contracting exemptions. There is now one anti-avoidance provision that covers the whole range of exemptions there. We anticipate the two other specific exemptions, one to do with insurance agents and the other to do with direct selling agents, will shortly be removed. We're waiting for the other jurisdictions to come on board, and as soon as they get through their parliamentary processes, we feel that that will be across the jurisdictions, that those other two will disappear as well. Obviously, you're fully aware that there are a lot of difficulties with contracting. The important thing, I guess, is to remember that in a lot of cases where you merely just have a person with an ABN, that we will probably see them as a casual employee. And it's very difficult because they could be invoicing you, they're not getting paid through the payroll, they're getting paid through the accounts. But if they're merely just providing their labour and not much else, and they don't tender for the job, they don't bring anything else much to the job, then it's going to be very difficult for us to say that we see them as an independent contractor. Now, having said that, the onus of proof is on us to prove, our auditors have to prove that the person that that you've said is an independent contractor, in fact is working under a contractor service. So the onus of proof is for us to come up with there that there is a contract of service. However, in a lot of cases, if it went to the courts, we've discovered that, and particularly where there is no independence, that the people are merely just going to be seen as common law employees. So we need to look at the total relationship, we need to look at the roles and responsibilities of the two parties, the worker and the hiring business. And it's not easy, and I would advise you to, if you're not sure, to come to our office or to ring us up and get guidance on the matter, because it is a complex area. We don't have a tool like the ATO because we feel that it's a very difficult area, and we take a common law approach, looking at the whole relationship and looking at roles and responsibilities. Obviously, in the 21st century, people's roles can change. They can be an employee at 1 minute and then they can change and become an independent contractor. And sometimes businesses don't let us know. Their status has changed, they're working differently. So we need to be kept up to date. With any of our exemptions or exclusions, substantiation is required. Once you get to the exemptions, if you're claiming an exemption or exclusion, you need to have substantiation. The onus of proof is on the hiring business to prove that they are entitled to one of a number of exclusions. Particularly, I would say with the 180 days one, where a lot of businesses just think that it's a multiplication of the 90 days one, which it's not. It's more or less you have a particular service that needs to be done where you need to bring in some specific expertise, not for a peak period where you need to bring in some extra casual staff to get you through that period. If you're unsuccessful in getting an exclusion or exemption, it's important to remember that there are a certain amount of concession given to various different industries where materials are bought. We have a revenue ruling in place for that you can go to, Revenue Ruling 18, and for different industries there are different amounts that would be considered to be labour content. GST is never to be included in the amount which would be liable. What we're finding in some areas is that there is a reverse payment under a relevant contract. Instead of the payment coming to us from the principal contractor, it's coming from a subcontractor. Now, under our anti-avoidance provisions, we can deem any party to be liable to payroll tax if we believe it's there to diminish or to reduce the amount of payroll tax. So it's important that that people are aware that we have these anti-avoidance provisions in place. We've had a lot of cases with employment agencies over the last few years. it's most important to realise that there is only one exclusion available for agencies, and that is where the end user or client is an exempt employer under our legislation and they fill out a declaration. We have discovered that there are some businesses that are not formal labour hire or agency businesses, but are operating very much like an employment agency contract, an on-hired contract. And we have picked up a few of these cases where we've been successful in the New South Wales Civil Administration Tribunal and the Supreme Court, where they have been seen as employment agency contracts, where they thought they'd hired a person under a contract for services, but they found out that it was an employment agency contract. So it's an area there that I think that we need to be aware of. If you need to contact us, we have people there that can help you. They can answer 90% of your calls front up. We have 2 assigned new client account managers, and we're always willing to listen to your perspective if you have a problem to do with payroll tax. Thank you for your attention.
Thank you very much, Wayne and Glenn, for those insightful comments. I look forward very much to seeing what happens in the FBT space in the next 12 months, and it's always good to know what to look out from a payroll tax perspective. I'm going to hand over to the panel, to our commentators, to see if they've got any comments or observations in relation to the 2 presentations or other issues in general first, and then we'll open up to the audience for some questions. So Paul, would you like to start?
Thanks, Fiona. It never ceases to amaze me, even after many years working in this field, how often you come across issues that you haven't had to deal with before or don't have a clear answer. But what are some of the key issues that we've been dealing with at the moment? And Glenn alluded to one of those in his presentation earlier in terms of the consultation hub issue, the treatment of travel expenses and how long one can be travelling for business, and those expenses can be deductible and therefore not subject to FBT. Most commonly arises with people coming from overseas following the change in the living away from home allowance rules, but can also arise in relation to slightly longer training sessions for younger people in your organisations who also may not satisfy the living away from home rules. And although there was some initial indications from the tax office of adopting a fairly practical approach, in more recent times they seem to have regressed back to the 21-day guideline in that old ruling MT 2030 becoming almost the rule of law, as a result of which we agitated for that to become a consultation hub issue. The group met for the first time a couple of weeks back, and I think there are some promising signs that the tax office might be prepared to look at a more principled approach, which would look at the type of accommodation, for example, whether the person brings family with them, how long, and many other relevant factors. That will be a somewhat time-consuming process, though, because the likely outcome of that process will possibly be some sort of public ruling. So that will take anywhere between 9 to 12 months to actually see the light of day. So in the meantime, we'll have to play that one by ear a bit. Another issue, particularly around employee share plans, what I would say is be very careful about dropping the information that you put together for income tax reporting directly into your payroll tax return, because there are some differences between the federal income tax legislation and the payroll tax legislation, principally around the treatment of share options as well as the treatment of employment cessation. So you do need to be careful you're not picking up the wrong amounts. Contractors, certainly that's already been the subject of discussion, and I think we do need to be careful. The case law is moving in a direction that many people who might have been considered traditionally contractors are more likely these days to be casual employees unless they can truly show that they are acting in their own business. there are differences between all of the various employment taxes, whether it be PAYG, whether it be superannuation, whether it be payroll tax. So again, be careful, you need really good processes. And finally, Wayne mentioned the tax office decision tool. But I think you really need to be careful in being too overly reliant on that, because like anything else, the output is only as good as the input. And if, for example, you might come to a view that what you've got is a results-based contract, so you put that into the decision tool, it will almost certainly spit out that the person is a contractor. But if you've misconstrued that input, then your answer is clearly not worth the piece of paper it's written on. So much care needed. I think the final thing I'd like to say, that the real emerging trend in the employment tax space, I think, is the increasing use of data analytics. We've seen already the tax office and some of the state revenue authorities, when they do reviews and audits, asking for an electronic download of information so they can take that away, analyse it, come back and present their conclusions to you. What it's done is it's caused firms like ours to basically develop our own tools so that we can not only attempt to replicate what the revenue authorities are doing, but also use those tools to help employers and organisations to find ways potentially to also save on their employment tax costs by looking at their payroll coding, looking at their general ledgers and entertainment classification, for example.
Thanks, Paul. Donna?
Okay, well, the observational point that I want to make today in the short time I have is that I really want to encourage employers to stop thinking of FBT as something that we do simply in April and May, and to start really working on FBT throughout the year. It's something that you certainly can perform, or work that you can do throughout the year. And when you get to April, May, it really should be just a sanity check. And the things that I think, and some of these are probably obvious to you and others not so obvious, but clearly reviewing your FBT sensitive GL codes is something that definitely can be done either monthly or quarterly, depending on the volume of transactions you're dealing with. But other things that aren't so obvious are for those of you that are hold or have conferences throughout the year. I know there's a lot of media companies and pharmaceutical companies that still do have these large conferences. In that situation, you certainly do need to get involved both before at the planning stage to make sure that the people organising the conferences know the implications of things that they're thinking of doing or agreeing on doing with respect to recreational and meal entertainment. You also need to be involved during the conference to make sure that there is adequate record keeping, and certainly after the conference, so that when invoices and that start coming in order for you to value any benefits that have been provided throughout the conference. Another thing that I think is extremely important is expatriates, and every year it's such a big area. We spend so much time going through expatriate benefits in April and May, and expatriates is certainly something that should be done when, as soon as an expatriate comes on board. You should have in your processes time, or you should review the contracts at the time that they come on board, so that you are aware of what benefits have been promised to these people, and then you can sort of start to gauge when those benefits start to be provided. And an example of that is their home leave. I mean, often home leave gets totally forgotten or buried in overseas travel, so we don't even know it's there, and it can take quite a lot of time to dig it out and work out exactly, you know, when he went away, who went away, whether it was his family, etc. The other point, and the last point I want to make, is that Glenn did discuss the extension of time given if you are working under a tax agent program. And this is fabulous. It does give us more time, but the reality is that in most cases your paid office will require the RFBAs well before the 25th of June. In fact, most of my clients start asking for RFBAs around the middle of June. So I do urge you to keep that in mind when you are sort of setting timelines and deciding your compliance timetable. That, and to talk to your pay office and find out exactly what their time frame is, so that you can factor that in into your compliance timetable. Thank you.
Thank you, Donna. Adam?
Okay. I agree with everything that Paul and Donna have said. They've made some really good points. One thing that I'd shed some light on, I don't think it's been raised, is around car parking. So there was a case during the year, Qantas car parking case, And this really essentially, without going into the detail, tested the definition of a commercial car park. And what it goes back to for the relevance of everyone here is that the ATOs historically expressed a view that car parks which don't provide car parking in the ordinary course of their business as a primary principle of their business, they charge penalty rates, they don't encourage all-day parking there, your shopping centres and the like, are not commercial car parks for the purposes of assessing whether you have a car parking fringe benefit. Stepping back, if you provide car parking to your employee and there's a commercial car park within 1 kilometre, you have a car parking fringe benefit that you pay FBT on. Pardon me. Now, what this case did was it tested the airport car parking facilities and whether all of the factors that were present there, so the penalty rates, the fact that the general public would not ordinarily park there unless they were actually going to the airport. So all of these range of factors and whether those factors precluded an airport car park from being considered a commercial car park. What that would have meant for Qantas, of course, is that there were no other commercial car parks in the area and they would not have an FBT liability. And of course, the reasons put forward were fairly similar, not identical, but fairly similar to the reasons that the ATO had previously concluded in tax ruling 9626, that shopping centres and the like were not commercial car parks. The court handed down their decision and were of the view that the airport car parking facilities were commercial in nature. And of course, that didn't change anything for Qantas because they were already paying on the car parking facilities. Of relevance to everyone here, if anybody has a car parking facility in North Ryde, for example, anywhere within Australia where there's no Wilson, no other commercial car parking within 1 kilometre, but there is a shopping centre, there is a university, there's a hospital, which have these penalty rate type of pricing structures. Extracting the court's decision and applying it to those circumstances, it means that theoretically, based on that court decision, you could well have an FBT liability on those car parks. A difficult thing, and it's a big change. So I think we've all been working with the ATO on this and trying to get a feeling for where does the ATO stand and where does this put businesses both for the 2015 FBT return historically and going forward. What we understand from the ATO is that they're looking at withdrawing that TR 9626 and issuing a new ruling in the next 12 to 18 months, I believe, Lynn, which really takes into account what the courts have said in the Qantas decision and what that would mean for businesses. The preliminary expectation is that they're not expecting to change their view, which will be helpful for everyone here because it would mean that the shopping centres, etc., which have not been treated as commercial car parks previously, would not be treated as commercial car parks. Until that time, the ATO has advised a number of times that employers can continue relying on TR 9626, which means that your shopping centres, your hospitals, etc., which have historically not been viewed as commercial car parks, will not be, which should give you some guidance for your return this year and next year until we see something further development from the ATO.
Thanks, Adam. Marty, do you have any comments?
Sure. Thanks, Fiona. I thought today I'd just comment on a few of the challenges that I'm seeing my clients dealing with in relation to FBT and payroll tax, and Donna's sort of touched on a few of them, but I thought I'd sort of go into a bit more detail. And that's primarily in relation to not necessarily the correct application of the law, but just the challenges in record keeping, substantiating positions, and also managing the time investment required to undertake the relevant required analysis. So from an FBT perspective, a few examples that I'll mention will be in relation to, for example, obtaining declarations, travel diaries. So to start with LAFA declarations, it's challenging enough to try and get a signed LAFA declaration back from a current employee. So you can imagine how difficult it might be trying to get one back from an employee that's since left the organisation. So companies should think about what can they do to try and obtain those LAFA declarations sooner rather than later, and not wait until the end of the FBT year to send a request out to get the LAFA declarations back. So it's important to think about whether it's worthwhile, if you don't have it already in place, to include in any exit procedures when individuals are leaving the organisation, to perhaps include an item in those exit checklists in relation to obtaining any required declarations from an FBT perspective, such as a LAFA declaration. In terms of travel diaries, we have seen in the last few years an increase in the number of business trippers or commuters, particularly in the ASPAC region. And so from an FBT perspective, maintaining travel diaries has been another challenge for many organisations. So it's important to be aware that the ATO has issued guidance in the last few years that it is possible to complete a no private use declaration in relation to business travel expenditure as opposed to obtain travel diaries. But the important thing to be aware of in that respect is that if you have a company policy that also allows for reimbursement of spouse travel, for example, that there does still need to be an analysis undertaken to ensure that the expenditure in relation to the spouse travel is picked up for FBT purposes. And another example in relation to meal entertainment, as Donna mentioned, to the extent that you can try and bring forward as much of the analysis from an FBT's perspective as possible, then that's going to take the burden off come April and May. So in relation to meal entertainment, if, for example, your organisation adopts the actual method in valuing meal entertainment, then think about analysing the general ledger accounts perhaps on a quarterly basis to try and take that pressure off at the end of the FBT year. In terms of payroll tax, one of the things that I'm seeing my clients dealing with and having most challenges with are contractors, as Wayne mentioned. So in that regard, again, think about whether it's appropriate to have some kind of protocol or process in place in connection with the onboarding of contractors. So when you first engage with them and have a checklist that requires the contractor to perhaps answer certain questions to help with the analysis of whether that worker is in fact an employee or an independent contractor, and taking that a step further and incorporating into those checklists a series of questions that will help make an assessment as to whether a payroll tax exemption will apply to that contractor. One of the challenges with that is if you've got an organisation that has multiple business units spread across multiple cities or states, just having that education process rolled out to those people responsible for the onboarding process. So think about whether or not you can try and implement a process whereby that education is maintained and there is a reference manual perhaps that can be referred to.
Thanks, Marty. It's interesting to see that there are some really long-standing rulings and that may be looked at this year. I think MT203 on the car parking one. That's really interesting. Now, does anyone have any questions? Yes, just down here. Can you wait for the microphone, please?
A question for Paul based on your comment around the super tool and not being able to maybe rely on the outcome based on your input. One of the first things that it asks for is who are you dealing with? Are you dealing with an individual, a company, a trust or a partnership? And as soon as you go past entity, it says no super applies. Do you see that ever being questioned by the tax office?
I haven't seen any evidence of that to date, but certainly if you look at some of the case law, there are some comments in the ACE insurance case, for example, which wasn't a tax case, it was an industrial relations case, but could possibly provide some support for that view. There are also, if you go back to one of the Roy Morgan research cases, I think the one that looked at superannuation from memory, there are some almost throwaway comments about possibly applying to entities. So at the moment I would still say the answer is no. I think the legislation is fairly clear in terms of superannuation that it talks about payments to individuals. So the only way you could effectively look through an entity would be by saying that it's a payment by direction. But you know, there are enough snippets in case law that might support a change at some point.
Great, thank you, Paul.
Sorry, if I can just add to that. I think the extension to that, there was another case which again wasn't, it was a superannuation one. It was a Hall's Plumbing case, which was about a couple of years ago now. It was one of the individuals who was owed superannuation was operating through a trust. And I think the one thing to be careful of, engaging with an interposed entity, a company or a trust, is one thing, and that certainly helps support, and that's what Paul's saying. What you need to be careful of, though, is who are you engaging with? So have you got a properly executed contract or agreement with that interposed entity? Are you getting invoices from that interposed entity? In the cases that are the case that Paul mentioned and the Halls Plumbing case, the failure of appropriate documentation and practical relationship between the parties to demonstrate that there was an interposed entity which was operating business, which was engaging with the principal, that seems to be what could result in a failure in the process. So I can't emphasise enough the importance of having appropriate documentation in place, properly executed contracts. I mean, contracts that are signed by, you know, if it's a one-person company, and at the end of it, it's signed by the individual and not in their capacity as a director of a company. That's an example, you know, our employment lawyers will talk for days on that, but that's one of the examples that the courts could look at in establishing, well, who are you really dealing with? Are you contracting with the company, or are you contracting with the individual and paying the company?
Or even worse, where there isn't a contract at all. Don't laugh, it happens a lot.
We laugh, but you shouldn't.
Yeah.
So are there any other questions from the floor? It's all quiet this year. I guess one of the questions I'd like to ask the panel then is in relation to the changes for redundancy and training. Does anyone have any comments on that and whether training as part of a redundancy package should be subject to FBT?
I think, I can't remember the number of that ruling, but I was actually involved with that request when it was submitted, and I was just blown away with the response in terms of I can't believe the tax office took such a narrow interpretation. You know, I think it's not really a big leap for them if they're quite happy that outplacement services fall within the terms of that exemption, that it's very hard to see why retraining also should not fall within it. But it is what it is for the moment. It's a public document. It's a formal view, and so therefore you really put yourself at risk of penalties if you ignore it.
Thank you. I've got a question from the webcast. Is a non-taxable ETP for income tax purposes taxable for payroll tax purposes? So obviously that one's for you, Wayne, or maybe the panel.
No, we follow the ATO's rules. If it's not taxable in the hands of the person for income tax, but it won't be taxable for payroll tax.
Great, thank you. No other questions from the audience? No. Yes.
If you're dealing with a major labour hire company, sorry, if you're dealing with a major labour hire company and you're employing staff on a temporary basis through them, do you have payroll tax or super requirements or anything, or you know, they're obviously paying their payroll tax and their super for the employees, so that obviously, does that obviate any liability on the company?
Wayne?
For a payroll tax perspective, as long as it's an on-hired contract, that is, that they continue to pay the wages or the salary of the worker that you've got there, then they are liable for the payroll tax. However, if it was a placement where they merely just placed an employee with an employer, then the employer would be liable for payroll tax.
So if you hired someone, for instance, 3 months through a labour hire contractor and then ended up employing him, you would be liable for the full period?
You would only be liable from the time that they become your employee under a contract of service.
Same for super?
Well, from a payroll tax perspective, it would be the same.
No, I was asking from the ATO point of view.
It would be the same from a superannuation perspective, but be careful. Your initial comment about the assumption that the labour hire company has paid those taxes is not always a valid one. In Wayne's presentation, there's a reference to a case involving CXC Consulting, where the bone of contention there was that they were a labour hire company but didn't pay those taxes. So you do need to be careful that you can't inadvertently become liable if they don't pay them. So it's always, I think, absolutely critical to confirm with them that they are taking that responsibility.
Any more questions? Just Kate.
Can I get Marty just to expand a little bit on the no private declaration re-travel? Is that no private declaration as in that's the declaration that's made at lodgement of the return, and around ensuring that your policies state that no personal use will be enjoyed by the employees on their travel benefits?
Yep, that's correct. So it's a declaration that would be signed at the time that the FBT return is prepared and prior to lodgement. And it's basically indicating that there is no private travel expenditure. So ideally, you'd need to have a policy that indicates that the company only reimburses business-related expenditure.
And that's a document, just to add to that, that's a document that someone senior in the business, a public officer, is going to sign. And to get someone like that to sign a document that confirms that the employee who was travelling did not charge any private expenses back, they're going to want to have some degree of confidence that they're signing the right thing. And the policy saying these are the things that we will reimburse is the first step, and that's the major step, such that if the employee stays on for an extra week at the end of their business trip to visit family, that we as a company will not reimburse you for costs in connection with that stay or that portion of the stay. What a lot of employees are doing now also is when the employee actually lodges their expense claim is like an electronic declaration. I'm signing when I claim this expense that I'm claiming these expenses in accordance with the company reimbursement policy. So those are just a couple of layers which give you a little bit of comfort, a little bit of protection as to how you're ensuring that you're signing the right thing.
I just want to add though, I do have a little bit of an issue around it because you really do need to have substance to the policy, and it's fine to have a policy, but you need to enforce it. You need to be seen to be policing it, and this in particular, where you have an organisation with a lot of overseas travel in particular, it can be very difficult to keep an eye on these things. So you've got to be. I don't encourage it. It is if you in a situation where you don't have volume and you can keep a track of things, then fine. But where there is a lot of overseas travel, just be very, very careful. Because if the ATO were to do an audit, they're going to want to see that you're actually keeping an eye on things and policing that policy. It's not just a document that sits on a shelf.
And I think best practices, and what I've seen organisations do, is still require a travel diary to be completed at the time that the expense claim is being submitted. And so then it's sort of like a foolproof position where you're basically requiring that before expenses can be reimbursed. But to the extent that it's not a reimbursement of expenses, it's just a direct payment by the company, then perhaps it's a bit more challenging. But ideally, if you can incorporate it into your process requesting travel diaries in any event, then that's the best approach to take.
Can I just confirm on that travel diary issue, that's to do with domestic. Is a travel diary for overseas of greater than 5 days is required anyway? Or is that no private...
This is in replacement to the travel diary required for the overseas travel.
Great. Thank you. I've got a question for Wayne. What is the next step towards harmonisation for the states? It would seem that there's quite a long way to go before that happens, and there's a couple of points that you raised during your presentation where you're waiting on the other states.
Well, I can say that when it comes to the base of wages, we're 99.9% the same. We have the same grouping provisions across the states and territories. When we come to contracting, the only state that doesn't have contracting provisions is Western Australia, that just merely takes a common law approach. We have the same nexus provisions. We've made some progress since the 1st of July 2007, but I mean, always, the different states and territories are competing. They're competing for the business dollar, and they're competing for their jurisdiction in terms of revenue. So the rates and thresholds obviously are going to be different because every state and territory, their economy is different, and some states and territories have got very bad budgetary positions, and others are are doing a lot better. So I think that's going to depend upon what happens, I think, at the Commonwealth. We'll have to wait and see what comes out of the white tax paper and also from the Council of Australian Governments. But at the moment I can't say that anything is about to change.
Thank you. And there's an FBT question on logbooks. Can a 12-week logbook cross over to FBT periods? And for use in the 14-15 year, what would be the latest date it could be completed by?
Probably the second of April. They can cross over to FBT years, but they can only, so if, let's say you started your logbook on the 1st of February 2014, so that means your 12-week period finished end of April 2014. That means you can use that logbook for the 25th for this year, but you couldn't use it for last year. What was the rest of the question?
Yeah, so that was it. So could I use it for the 14-15 year? If
Yeah,
it
so if it ends in 15, you can use it in 15, and then you can carry it through for 4 years. But you can't use it, you couldn't have used it going back.
I couldn't use it for 13-14? Yeah. Is there another question from the audience? Yes, down here at the front.
This is just a travel versus LAFA allowance question. So any of you can answer. So we have cases where there's power and telco linesmen that are required to travel for a series of consecutive weeks, but to different locations. So say, if you look at the payroll reports, they would be receiving travel allowances for maybe a consecutive 6-month period, but they would be travelling to different locations. So would that be considered or deemed to be LAFA if they are receiving these travel allowances for 6-month periods? Or would you consider where they travel, like whether they're travelling to different locations?
I think there's probably enough authority that you could take a view that they're travelling, they're not living away from home. If the nature of their occupation is essentially itinerant in that sense, they don't have a fixed base. However, if any or all of those different locations are for more than 21 days, there is a level of risk that the tax office might take a different approach.
So how about if it's, say, over the 21 days, but it's, 5 weeks? Would that be considered to be LAFA because it's over the 21 days, or would they look at the different factors for MT 2030?
Personally, I would always take a view in the scenario. Obviously, I haven't looked at it in detail, but from the way you've outlined it, that it's travel. If it was 1 5-week period of itself, the risk is probably much higher. But if they're continually going to different places, it's hard to see the tax office. Sorry, it's hard to justify any different approach. But you never know what's going to happen.
Yeah, there was a private ruling that came out last year, towards the end of last year. An employee basically itinerant in nature, and that went on for months and months and months, but different locations very frequently. And I believe the outcome was that they were travelling, and really they weren't establishing another place of residence wherever they were going. They were just constantly in transit, constantly in hotels, or if there was a hotel in the location they were going to. The 21 days is there because it's the only number that anyone has.
Yes.
That's, and for that reason, it is the practical rule that a lot of businesses use. And if you ask us the question, it's the only rule that we can only base our answer off. But I have seen businesses apply to the ATO for rulings and access living away from home concessions where the period's not quite 21 days, or argue that it's travelling, more importantly. If the period is more than 21 days, it really comes down to the nature of it. What are they doing? Are they just itinerant in nature? So if your workforce is big enough to warrant it, you might want to consider looking at putting the question to the ATO. If the facts line up behind it being travel rather than living away from home, then you may want to consider it.
Thank you.
I've got another question too. Is anyone aware of any current or proposed software solutions to assist with managing contractors and the decision making? Clearly there's the ATO decision tool, but the cost of compliance is very high and it's a large issue. So is anyone aware of anyone who's developing a solution?
We all are, aren't we?
I almost feel like this question was planted by someone in the Big Four firm.
To do.
Yeah, look,
We're all doing it, I think.
I think all of our firms are working on something. I don't know the different statuses, but have a chat to anyone. There are solutions out there. At the end of the day, you are going to have an unavoidable problem of when you engage somebody, the nature of the contract will not necessarily be the same as the nature of that contract in 3, 6, 12 months' time. So no matter what kind of software you use, the software can help you with managing volumes of contractors if you set it up right. But there is still going to be an ongoing need, no matter what you use, to make sure that you constantly revisit it, because if you've got somebody sitting in a contract position in 18 months' time, you know, you really need to take a look at what you're doing. So I think the answer is have a chat to any one of us. But there is a need for ongoing monitoring.
I think we'd all agree, and certainly, you know, I think Donna and Marty have already commented, but the key is really the process and having a consistent and vigorous process. And no piece of software is going to override that need, because it's like my comments about the contractor decision-making tool. Unless you're putting the input in correctly at the front end, unless you have the right process to make sure it all fits together, you're still going to get the wrong output.
Look, from my experience, and I worked out in commerce for 10 years, so I found the biggest issues around, or the people who had issues around contractors, or organisations that had issues around contractors, were those that did not have a champion or a person that really oversaw the process. Now, you would think that the engaging of contractors would be something that perhaps HR should be involved in at the very least. But often what does happen is you might have different departments that will decide they need someone for 6 months, and they'll just go out and recruit and promise them whatever they might promise them to pay them by invoice. And there's no sort of communication with anyone else. So my advice to you, those of you that do have a lot of contractors or have an issue around contractors, is that you really do need to find someone to be the champion, and to be the one that they don't necessarily have to do all the work, but they need to be the communicator. They need to be the one that tells the pay office, if the pay office needs to know, or if AP is making payments, that the payments being made by AP are told or are referred back to the person who's preparing the payroll tax return or the super or whatever it might be. So that's what I think is something that can help with the contractors.
And I think along those lines, perhaps the most critical piece of the whole decision-making process is to take the final sign-off / approval out of the hands of the business units that want to engage the person. Otherwise, they will forever find ways to bypass the process.
Great. I've got a technical question. Can we elect to use the actual method for entertainment facility leasing expenses while electing to use the 50-50 method for meal entertainment? Do we have to be consistent between elections?
Yes.
Marty, would you like to?
Yes.
Okay.
Yes, you can.
They're totally separate.
Yeah.
They're separate benefits.
Unanimous.
Separate categories of benefits. So meal entertainment is one type of benefit. Entertainment facility is totally separate, has separate sets of rules that apply to each one of those.
And in fact, quite often you'll find that an organisation that is able to use the actual method for entertainment can still get some benefit from using the 50-50 for entertainment facility leasing.
Depending on whether the employees outnumber the customers.
Well, that's right.
Okay, any comments from the audience? Questions? Anyone from the panel want to have another?
I was just going to perhaps ask Glenn. Glenn, you mentioned in your presentation about the ATO looking at reviewing or perhaps providing more guidance around the application of the minor benefit exemption. And I know we had the ruling that came out a few years ago, and I perhaps think that a lot of people were hoping the ATO might reveal a magic number of how many benefits or the frequency, and of course that's wasn't included in that ruling because it does depend on the facts and circumstances of each individual scenario. But I was curious to know whether you might be able to share any sort of information around what the plan is around that additional guidance.
Yeah, the plan is to provide better guidance for that, and to see whether we can come up with, say, a safe number to say that if you provide entertainment to an employee and the total value is under a certain amount, that would satisfy the exemption. The difficulty we have at the moment is if we come up with a number for, say, entertainment, and if we were to say the number was 10, that there's a lot of difference between getting 10 $25 meals as opposed to getting 10 $280 meals. So that's the reason, the way the legislation's worded, we can't come up with a clear number, but hopefully we can give some better guidance around that.
Okay, great, thank you. Yes, down at the front again.
Can I just clarify, travel allowances that are up to the reasonable limits as indicated by the ATO, do they get disclosed on the payment summary? Because they obviously don't get PAYG withholding, I'm just confirming, and do they get disclosed on payment summaries?
Provided they satisfy the relevant requirements, there's no need for the payment summary disclosure.
Thanks, Paul. Yes, down the front again. Sorry, can you wait for the microphone? We're coming. Thank you.
This is a question for Wayne. It's a payroll question. So do you report wages where employees works or where employee lives? For example, what state do you report wages if employees usually work in New South Wales, but they travel and work there in, for example, Queensland for 3 months?
Thank you for that question. That's a nexus question, and we solved that from the 1st of July 2009. We did it on a monthly basis, and what we said from that date onwards is that if a person works the whole month in one state or territory, it will be liable in that state or territory. However, if they work across 2 jurisdictions, 2 states or territories in a calendar month, it will be where their principal place of residence is. So their principal place of residence comes into effect from that in that circumstance. And that's where we've had some problems. That's why we had to make that decision, because we had people working across jurisdictions. You could imagine, in the transport industry, and salespeople who work maybe 2 or 3. They work in 2 or 3 jurisdictions in a month. And we decided among the jurisdictions ourselves that the best decision, the first fallback position, would be the principal place of residence, because if they're living in that state or territory, they're drawing upon the community services, so the tax should go to that state or territory.
So say we had an example where the employee was living in ACT but working in Queensland. So he never worked in ACT. So in that example, you would pay the payroll tax in Queensland, is that correct?
Absolutely correct, okay. Yes.
It becomes easier if the employee's only working in one state for a whole month, because that's where it's going to go. It becomes more complicated when they're moving between states in the same month, and that's when you fall back to these nexus provisions to determine which state's going to have the taxing rights, which will probably go back to where they live.
Okay, great, thank you.
Another question over here.
Actually, I just thought I'd give a tip about that. We found, particularly with the mobile and internet being able to work from home, we this year found some employees who were actually home-based in another state that were not paying we weren't paying payroll tax in the right state. So just be careful about your home-based workers. That's just a tip from me.
Thank you. Okay, another question down here.
Can I ask a bit detailed question about the presentation slide and called contractor exemptions common mistakes. There's one mistake listed here, saying engaging 2 or more workers ensure they are delivering the core service. Because in my understanding, if a contractor engages 2 or more workers, it will look more like an appropriate contractor instead of being an employee. But however, it's listed here as a common mistake. Can I learn a bit more about this? Thank you.
Yeah, that's one of our more common exclusions or exemptions there. And a classic example would be if I'm going to, build a house. Okay, we need somebody to lay the scaffolding, somebody to put in the electrical wiring, and somebody to do the putting in the piping, a plumber. So you've got 3 people to do it. Now, that's more than 2. So the core requirement to get a house built is those things have got to be done. So the only requirement that there's a restriction on that or limitation is where there's a partnership. You need to have a third person in there, natural person to come in or another company to come in to do the work, because 2 partners by themselves will not give you an exclusion. We put that in some time ago. So as long as they're doing the core requirement, I'll give you an example where you wouldn't get the exclusion or exemption. Say, for example, we have the example of a bricklayer, and he's got to lay 400 bricks. His wife is the receptionist. The core requirement of that contract is to lay 400 bricks. His wife has nothing to do with the laying of the bricks. Therefore, there couldn't be an exclusion or an exemption under those circumstances.
And I've got a question from the webinar. Should we pay payroll tax if an employee is working overseas? So they're keeping you busy, Wayne?
We're going back to our nexus provisions and our exemption again. If the employee was hired from, say, for example, New South Wales, and they were being paid back into an Australian bank account, whatever bank account, whatever jurisdiction that bank account was, as long as the period of time didn't go beyond 6 months, then their wages would be liable for that period of time. However, if they worked greater than 6 months, then none of those wages would be liable if they're working greater than 6 months overseas. Now, if even for up to the 6 months rule, if it was paid into a jurisdiction outside of Australia, into a bank account outside of Australia, then none of the wages would be liable.
Got another payroll tax question on the home workers. If an employee is working from home in Queensland for a company in New South Wales, where would the payroll tax be paid?
Again, if they're working the whole month in Queensland, then Queensland would pick up the tax for that month.
So there might be some more people who need to register. Is there any more questions from the audience? If not, I think we'll finish. I'd like to thank our speakers, Glenn and Wayne, and thank our panel, Paul, Donna, Adam and Marty. Please give them all a hand. I'll hand over to Tony now.
Okay, Fiona, thank you very much for sharing today's session, and to our panel, thanks very much for taking the time to share your insights and knowledge. We very much appreciate it. From Walters Kluwer, as we are now, a small token of our appreciation to all of you. Thank you very much. And thanks to all of you for coming this afternoon. I hope you found the session informative. Just a small reminder again, please, if you can complete your evaluation forms, and hope to see you on the 4th of May at the Tax Risk Workshop. Otherwise, we'll see you at the next network events. Thanks very much and have a great afternoon. Thank you.